guys, welcome back to my YouTube channel, and today's vlog, I'll be discussing or focusing about taxation, the tax evasion and tax avoidance. Come on and let's start. First, we have the taxation. Taxation refers to the act of a taxing authority actually levying tax. Taxation as a term applies to all types of taxes from income to gift to estate taxes. It is usually referred to as an act. Any revenue collected is usually called taxation. Even though the main purpose of taxation is to raise resources to finance public expenditures in an administratively feasible, fair, and effective manner. Taxation also provides one of the main means to measure state capacity, state formation, and power relations in society. It is used to encourage or prevent certain types of behavior, correct market imperfections, and modify the distribution of income or wealth. However, taxation not only pays for public goods and services, but it is also a key ingredient in the social contract between citizens and the economy. How taxes are raised and spent can determine a government's very legitimacy. Holding governments accountable encourages the effective administration of tax revenues and, more widely, good public financial management. Moreover, the concept of taxation is also important to businesses because governments can fund this money back into the economy in the form of loans or other funding forms. Let's have the history of taxation. It is a matter of general belief that taxation are of recent origin, but in ancient time also taxes were levied in some form on sale and purchase of merchandise or livestock. It was all over world. In India, Kautilya's Arthashastra, which deals with the system of taxation in a real, elaborate, and planned manner. Furthermore, taxation is a mark of civilization. Tax evolved and developed independently in the great ancient empires. The concepts that evolved were transported to other empires and culture were tax ideas took root. This pattern continues through to today as nations are influenced by developments in tax from other countries. So in this chapter on the evolution of property taxes, inheritance, estate and gift taxes, consumption taxes such as excise taxes and sales taxes and income tax are examined. And these taxes are traced from their roots on through mutations. The transportation of these taxes is also described. Next, we have the tax. So it was only for the good of his subjects that he collected taxes from them, just as sun draws moisture from the earth to give it back 1,000-fold. So this means that governed people collect taxes to be returned to the people. The taxes that are collected is for the benefit of the people, and it seems like a cycle to just return the money for those in need. So for example, you have an income of 10,000 a month and a tax of 1,000, but the next salary you still receive only 10,000 when you give 1,000. So the more you pay in the tax, the more you will gain. Let's proceed to the modern definition of tax. Tax is imposition of financial charge or other levying upon a taxpayer by government or other functional equivalent of the state. Paying the right amount of tax is a social responsibility to the country. The taxes we pay will go to the government funds that will be used in developing and improving the government facilities and life of Filipinos inside and outside our country. Taxes help raise the standard of living in a country. The higher the standard of living, the stronger and higher the level of consumption most likely is. So businesses flourish when there is a market for their product and services. With a higher standard of living, businesses would be assured of a higher domestic consumption as well. Taxes are essential and every citizen is meant to reap benefits of these taxes. This is why it is important that citizens endeavor to pay taxes and understand that it is meant to be more than just a money grab from the government. Let's have the government policy. The organizational history of Income Tax Department starts in the year 1922. In 1961, Direct Tax Advisory Committee set up Direct Taxes Administrative Inquiry Committee constituted, and Income Tax Act 1961 came into existence, which extends to whole India and became effective from 1st April 1962. Every year, a budget is presented before Parliament by Finance Minister. Most important component of budget is Finance Bill, which contains amendments which are sought to be made in the area of direct tax levied by central government. So although a finance bill is a bill that concerns the country's finances, and it could be about taxes, government expenditures, government borrowings, revenues, and etc. Since the union budget deals with these things and it is passed as a finance bill, a bill shall not be deemed to be a money bill by reason only that it provides for the imposition of fines or other pecuniary penalties, or for the demand or payment of fees for licenses or fees for services rendered, or by reason that it provides for the imposition, abolition, remission, alteration, or regulation of any tax by any local authority or body for local purposes. And now let's proceed to the types of taxes, which is direct tax and indirect tax. Let's have the direct tax. The taxes whose burden falls directly on taxpayers are direct tax. For example, is income tax, wealth tax, property tax, and etc. So direct taxes display the importance of taxes by reducing income inequalities with its progressive tax structure. Citizens are taxed in proportion to their economic circumstances, thereby encouraging social and economical equality. Additionally, with direct taxes, taxpayers remain aware of how much tax they can be expected to pay in a financial year and prepare well in advance. Direct taxes are also useful in controlling inflation, as any change in their rates can help in regulating demand and supply in the economy. Let's have the indirect tax. Indirect taxes are the taxes in which the burden of paying tax is shifted through a change in price. For example, is custom duty, excise duty, sales tax, service tax, and etc. So the importance of taxes for the government when it comes to indirect taxation is that they are an automatic function that accompany the buying and selling of goods and services across the country. So they are therefore easy to collect and convenient for both taxpayers and the tax collection authorities. They also help broaden the country's net of tax liabilities, gathering contributions from those sections of society that are otherwise exempted from direct tax. So let's proceed to the income tax. It is a tax on the income of an individual or entity levied by government. It was introduced in 1860, discontinued in 1873, and reintroduced in 1880. So income tax, it is a levied or unpaid by the same person according to the different tax brackets as defined by the Income Tax Department, and it is imposed by the government on all the income that is generated by various entities within their jurisdiction. However, all individuals and businesses have to file an income tax return every year to determine whether they owe any taxes or are eligible for any tax refund. So for example, a person who experiences a reduction of income due to a job loss will typically owe less in taxes. So the employed person will pay more in taxes but will have more income available for purchases. More recently, however, opinion has shifted away from the view that the income tax should be used for their purposes because of the cost involved and in terms of incentives and other distortions of economic behavior. Let's proceed to the income tax, which has personal tax and corporate tax. Personal tax, it is levied on the income of individual, undivided family, and other association of people. It is a tax levied on the wages, salaries, dividends, interest, and other income a person earns throughout the year. The tax is generally imposed by the state in which the income is earned. However, some states have reciprocity agreements with one or more other states that allow income earned in other states to be taxed in the earner's state of residence. While the corporate tax, it is levied on income of registered companies and corporations. It is a tax on the profits of a corporation where the taxes are paid on a company's taxable income, which includes revenue minus cost of goods sold, general and administrative expenses, selling and marketing, research and development, depreciation, and other operating costs. So paying corporate taxes can be more beneficial for business owners than paying additional individual income tax. Corporate tax returns deduct medical insurance for families as well as fringe benefits including retirement plans and tax-deferred trust, and it is easier for a corporation to deduct losses too. Personal income tax. Income from all the sources are considered. Certain rebates, deductions, expenditures, insurances are not considered for levy tax. It is progressive. Example, if income increases, tax rates also increases. And it is levied on the basis of slabs. So we have here the slab for personal income tax. So first, annual IIT rates for all individuals, Hindu undivided families, associations of persons, bodies of individuals, or artificial juridical person. And the second, the annual IIT rates for individuals aged between 60 and 80 years anytime during the previous year. And the third, annual IIT rates for individuals aged over 80 years anytime during the previous year. Corporate income tax. Rationale for corporate tax is that a joint stock company has a separate entity so taxed separately. A corporation pays taxes on behalf of income of shareholders, on dividends paid to them, and each shareholder get a credit till 1960 to 61. Now shareholders don't get credit because entity treat as separate entity. Corporation pays on flat tax rates, and it is different for Indian companies and foreign companies. In addition, corporate income taxes typically allow deductions for interest cost. This gives incentives for debt financing stronger when tax rates are higher. A multinational is motivated to minimize its total tax payments. Let's proceed to the corporate income tax. So there is two types of company, which is the domestic company and a foreign company. So the total income more than INR 10 million, domestic company has a 30% surcharge, education says, while the foreign company has a 40% surcharge, education says. So in total income less than INR 10 million, the domestic company has 30% education says, while the foreign company has the 40% education says. Custom duty and octroi. Custom duty is levied on import and export. From revenue's point of view, importance of export duty is limited. Since 1991, custom duty structure was pruned and now maximum rate of custom duty is 10%. Octroi is a tax on goods entering into municipality or any other jurisdiction for use, consumption, or sale. So in addition, customs duty is a tax which imposed on goods when transported across international borders, and the purpose of customs duty is to protect each country's economy, residents, jobs, environment, and etc. by controlling the flow of goods especially restrictive and prohibited goods into and out of the country. Excise duty. Excise duty is a tax charged on goods produced within the country. This is opposite to custom duty, and its other name is CENVAT, which is Central Value Added Tax. And this means that the end consumer is not responsible for paying the tax to the government, but they do cover the cost of the tax by paying more for the product. So by making products more expensive, the excise duty is supposed to discourage the consumption or waste of goods that are deemed to be harmful to consumers' health or damaging to the environment. Typically, excise duty covers alcohol, which includes beer, wine, cider, and spirits, and tobacco, which includes cigarettes, cigars, rolling tobacco, and chewing tobacco, and some energy products. Anti-dumping duty. Dumping is said to occur when the goods are exported by a country to another at a price lower than its normal value. This is an unfair trade practice which can have a distortive effect on international trade. In order to rectify this situation, central government imposes it. So furthermore, the anti-dumping duty is a tariff imposed on imports manufactured in foreign countries that are priced below the fair market value of similar goods in the domestic market. So the government imposes anti-dumping duty on foreign imports when it believes that the goods are being dumped and through the low pricing in the domestic market. So anti-dumping duty is imposed to protect local businesses and markets from unfair competition by foreign imports. So let's have the sales tax. This is the tax imposed on the sales of movable goods. Sales tax on interstate sale is levied by union government and on intrastate sale by state government. Retail or regular sales tax is only collected from the end user of the goods or services, since most commodities in the modern economy go through a series of manufacturing stages, usually handled by different entities, and a large number of documents are required to prove who ultimately bears the sales tax. So for example, suppose a sheep farmer sells wool to a company that produces yarn. In order to avoid paying sales tax, the yarn manufacturer must obtain a government resale certificate stating that it is not an end user. Then the yarn manufacturer sells its products to clothing manufacturers, and the clothing manufacturer must also obtain a resale certificate. So finally, the clothing manufacturer sells the Fury sacks to the retail store, and the retail store will charge the customer the sales tax and the price of the sacks. Service tax. The tax on paid services you take is service tax. Over past few years, it is expanded to cover new services. Few of the major services which comes under vicinity of service tax are telephone, tour operator, architect, advertising, health center, banking, and financial services, and etc. Value-added tax. The part of sales tax imposed by state government is called value-added tax. It covers more than 220 items. VAT rates vary based on nature of item and state. Value-added tax is levied on the sale of goods and services in the UK, and it is type of consumption tax because it is charged on items that people buy, and is also an indirect tax because it is collected by businesses on behalf of the government. So the purpose of VAT is to raise revenue to finance government spending like any other tax. So the advantage of VAT over other forms of sales tax is that it is harder to avoid. VAT is levied at every step of the supply chain but can be claimed back by businesses against the VAT that they charge. Let's proceed to the advantages of taxes. First, It helps to the government in its revenue, which is used to facilitate people of a country. It helps to control inflation. It restricts government to take loan from World Bank. And lastly, it utilizes public money in social welfare. Disadvantages of taxes. First, it restricts common people to get extra happiness at some extent, and if government misuse tax, we don't have any control on it. And now, let's move on to tax evasion and tax avoidance. So let's have the tax evasion. An illegal practice of a person or corporation that intentionally avoids paying his true tax. So tax evasion is illegal. So one way that people try to evade paying taxes is by failing to report all or some of their income. So sometimes people do not report income gained through illegal activities such as gambling and selling stolen goods, and other times they do not report all the tips they collect or the money they earn through legal activities such as garage sales, babysitting, tutoring, or yard work. So such money-making activities are part of the underground economy which exists as a way to avoid paying taxes. So if taxpayers fail to pay what officials says they owe, the IRS can assess a penalty and in addition to collecting the back taxes. So for example, is the underreporting income, taking unearned deductions, don't file tax returns, and deliberately underpaying taxes. Tax avoidance. Legal arrangement of a business financial activities in order to lower the tax liability. Tax avoidance is perfectly legal. So the IRS regulations allow eligible taxpayers to claim certain deductions, credits, and adjustment to income. For instance, some homeowners can claim a deduction for interest they pay on a home mortgage. Working parents may be able to claim a credit for childcare expenses. So there are also deductions based on the number of family members, and these are only a few of the many ways people can legally limit the tax they pay. However, the taxpayer must be able to prove that he or she qualifies, and many people pay more federal income tax than necessary because they misunderstand tax laws and fail to keep good records. So, an example of tax avoidance are increased retirement savings, maximize work deductions, tax smart college savings, use home equity, and health savings account. Let's have the tax evasion and tax avoidance. So in tax evasion, there is understatement of income, overstatement of expense, false or fictitious entries in books, while in tax avoidance, moving capital or labor to areas or countries with lower tax rates, and manipulating the tax parameters through legal means. Let's have computing the tax. Taxable income, which is the income, allowable tax deductions, expenses, income subject to tax, which is the net income. So income plus expenses is equal to net income. So in corporate tax rates, the United Arab Emirates has 55%, Uzbekistan has 7.5%, while in the Philippines, 30%. So taxable income includes the net sales, interest income, rent income, businesses income, while in non-taxable income, it includes gifts and inheritances, life insurance, and proceeds. Why is tax evasion ethically wrong? So compromising the purpose of taxation, it includes the peace, security, just distribution of wealth, and while in disobeying the government, it is disobeying laws, disobeying leaders. Tax avoidance. So in tax avoidance, there is ethical and unethical. So in ethical, Milton Friedman admitted that tax avoidance is advantageous in the long run. Tax avoidance may therefore have been essential for economic well-being, while in unethical, Rosario Manasan said that tax avoidance is similar to tax evasion. So loss of government revenue, increase in taxpayers after tax income, perverse effects on the equity and efficiency goals of the tax system. Okay, that's all for my discussion. I hope you will learn something, guys. Thank you for watching.